So my name is Matthew Owens. If you guys, I'm not sure how you guys found us, but usually it's the Phoebes or Meetup.com or something along those lines. I'm a full-time real estate investor. We flip about 10 houses a month right now. We've flipped over 600 houses in the last 10 years plus. I quit my CPA firm job in 2006. So I tell everybody I was a real estate genius for about a year, and then I got punched in the face. So, which was great. If you guys get punched in the face from real estate, you will learn the most you've ever learned in your life. So, it's upsetting, but at the same time, losing money is what actually makes you learn. It's like you're paying for your own education. And so, I had other people that I knew at that time that took the hit and didn't dust themselves off and pick themselves back up. They went and got a job somewhere. They went and look. Thank you very much. They went and learned their lessons, but then didn't pick themselves up. And really, your failure only happens when you don't pick yourself up. It's funny because now after going through literally headache after headache, I was telling these guys in the back how much headaches happen with real estate consistently. There's always a problem that needs to be solved. And there's always something that you have to, take care of or spend your time dealing with or finding a solution for. And the more of those financial hits you take, the more problems you actually encounter, the more you realize the power in the education you received. And I can tell you now, even doing 10 of these a month consistently, the problems don't stop. It's always a percentage, okay? And so, but over time, your mindset becomes super strong because you realize, well, there's $2,000, there's $5,000, there's, 20 grand, that might cost you money. But at the same time, you're like, okay, well, how can I make that money back? How can I reposition this thing to make more money so that I can so I can be successful in the long run? And that's really where your success as a real estate investor comes in, is your ability to take a deal that might look like a loss or might have a problem and reposition it or change it so that you can actually make money off of it. And a lot of it, too, comes from resources. And a lot of the reasons why I can solve a lot of these problems is because of the resources I have over the last 10 years. Capital resources, I have team member resources that know how to handle things. I'll give you an example. About 6 months ago, I had a property that basically the rehabbers went through and fixed everything. A month in, the tenant comes back and says there's some buzzing in the walls. What's going on? There ended up being a beehive inside the wall where the ceiling is dripping honey, and our property manager happened to be like a certified beekeeper. And I'm like, where did that guy come from? You know what I mean? It's kind of amazing. And that would have cost me $3,000 or something like that to cut all the walls out, take the bees out and everything from a certified beekeeper if he didn't happen to be one. I got really lucky in that situation. But now I know every single time I ever have a bee issue, I can go to this guy. But that type of example happens consistently where you're like, okay, I got a guy that will do that, and I got a guy that will do this, and I got a guy that will lend me money, and I got a guy that specializes in rehabs or specializes in multifamilies or commercial to be able to make sure that, maybe I'm analyzing a new commercial deal and I'm not sure about it, and I want to have a resource for someone that does that. I have a person that understands that space very, very well that can help me make sure that I'm not making those same types of mistakes. So those types of resources really get developed over a period of time of going to networking events like this and just meeting each other and trying to help each other out and realizing that every person in the room has a resource that you may not even realize you have yet. Somebody in here may have a rich uncle that they just know is balling or something like that, but at the same time doesn't realize that, what resource they really have if they actually educated themselves on how to protect an investor's money and how that worked and could explain it to somebody. Maybe they could get that rich uncle to invest with you on a deal, right? So, it's an example like that where, you bring in these different resources. Today, I'm going to talk a little bit about turnkey real estate investments, done-for-you type real estate investments. And I think there's pros and cons to the turnkey system, okay? You make a lot more money if you do it all yourself, right? If you do the work yourself, if you buy the property, if you market for that property yourself, negotiate with the homeowner to try to get a property under contract, do the renovation yourself, bring the money to the table yourself, understand all the due diligence involved in every piece of it, understand, if you're dealing with, turnkey invest in single family homes or something like that where you're dealing with properties, how does the property management and the management after the fact play out as well. So a lot of you guys may be trying to invest here in California for turnkey investments or buy and hold type of investments, and you'll learn really fast how much work it takes to do proper property management and proper investment analysis, because everyone wants to push that limit. Everyone wants to go through and say, okay, I can make this deal work, but it needs to be very non-emotional and very numbers driven initially. So everybody, when they're first getting started, is like, I think I got this great deal. Let me tweak numbers and do whatever I can to try to make this deal work. But if the deal doesn't work from the numbers, your initial conservative projections don't do the deal, especially in a market like right now when we're kind of peaking, right? We're, at least what it seems like, we're peaking in this market. Now, it could continue to go up for a couple more years. I don't know what is going to pop this bubble, right? Last time it was the mortgage market. This time it could be something in China or Canada or anywhere else that now they're in a much less of a stable financial position. A lot of these outside countries. China in the last fall had a lot of liquid reserves, and they've spent a lot of those reserves now. And now they're in a massive amount of debt as well. There's a lot of differences between the last market and this market, and they just kicked the can down the road. Now, my initial thought pattern with that is, okay, well, let's invest in real estate that hasn't skyrocketed like crazy, like California, where it has a highly volatile market, and that's why I invest out of state. Because no matter what happens, if I have positive cash flow on a monthly basis, then I'm in a stable position. I don't really care as much what happens to the market values of these properties at this in the short term. I'm looking at the long-term picture of this. And so unless I plan on getting out really quickly, then and then you want to look at your exit strategies before you get in. But unless you plan on getting out really quickly, a cash flow type of investment is probably one of the better investments you can invest in as far as stability and risk mitigation. You also want to look at, hey, when there's market fluctuations, what happened to the rents in those markets? Did they drop by 10%? And are you still going to be okay on your cash flow if they drop by 10%, if rents drop by that much? So you want to look at your downside risk and say, okay, if everything went down and crashed and rents dropped substantially, am I still at least going to be break even on my cash flows on a monthly basis? So before you start investing, you want to look at these different factors and try to understand what's the best scenario for me. Okay. Now, there's different types of turnkey, and this is turnkey done for you real estate investments. Mostly people think in their minds when you hear about turnkey is single family homes and Midwest markets that are renovated, tenanted, and managed, and everything's set up and ready to go for you. That's definitely one aspect of turnkey investing, and we'll talk about that a lot more in detail because that's a lot of what I do. So I'm buying these $100,000 to $200,000 houses in Memphis, Tennessee, where I primarily set up because of the economic research I did on that specific market, and so I've been doing these flips consistently. At the same time, I'll share with you guys the pros and cons of buying a turnkey investment versus doing it yourself as well, and what those number differences might be. Okay, and what the benefits are of going with a turnkey provider versus not, but also some of those cons too of what you're giving up to have an easily silver platter type investment, and also how to protect yourself because not all these turnkey providers are the same. Like you could be looking in multiple markets around the country. And I'm telling you right now, the different people's systems are night and day difference, and also the asset classes differences are night and day differences. So you want to make sure you understand the market as well as understand the team members that are doing this work with you. So that the team members are more important than the property in itself. So you want to be really, really careful when you're investing with a new company and do background checks and criminal checks and things like that. Get referrals, talking to tons of different people on the investor side and maybe even the tenant side as well to to see, do the tenants like these people? Or are they really bad property managers? Or do the homeowner or do the investor owners of these properties get the proper communication? Are they getting the proper accounting? Are they happy with the way they're managing properties? Do they feel like they're looking out for their best interest? And that's kind of a catch-22 when you're dealing with investors, because I can tell you 95% of the investors don't know what they're doing and don't know how to manage property managers correctly. And so they may think that something is running really well, but then but it's not. Or the opposite. So I had a client that she was like, hey, I'm not making as much money. This is totally different than what I initially thought. And this is about a year in. And I ran all the numbers for her, and she was making a ridiculously high return compared to the financial projections. But she wasn't putting it together in her head that, hey, this is only $300 a month in cash flow. In her mind, she put like 40 grand down, and or 30 grand down, and was like making like $300 a month in cash flow, which is a pretty decent return as far as cash flow goes, plus the principal reduction on the loan. And she was making above a 20% return on investment as a whole. And so, but she didn't realize that, because all she's seeing in her mind is, what's this measly $300? I don't care. She's making 200 grand a year as a realtor, And so it's a matter of breaking it down and understanding your numbers and looking at that on a consistent basis after you buy something. So, when you buy a property, it's very, very important, no matter what investment you do, to analyze the return on investment on a quarterly basis as well as on an annual basis, to make sure that you don't have a dud, to make sure you're not having problems. And if you are having problems, what was the root cause of that problem? Was it a tenant turnover that messed up that year that cost you money? Was it an AC unit that went out, or a water heater? Or what were the issues that occurred? And is it going to be a reoccurring issue in the future years, or is it more of a one-time instance? Because those one-time instances, they can happen, but if you have a reoccurring issues over and over and over again, that's when it can make it a dud-type property if you can't figure out how to solve that issue. If you're having plumbing issues over and over, is it worth it to go and redo all the plumbing on the entire house, including the line of the street, for 10 grand or 8 grand or whatever that happens to cost? Out here, the numbers are relative, because out there labor's a lot cheaper in some of these Midwest markets than here in California, where replumbing here on a whole house might be 15 grand. Out there, I can probably get it for 6 or 5. So we just did one on a high-end house that was actually like $6,500, and that was like a 3,000 square foot house. I mean, they messed up and they put the plumbing on the exterior walls for some weird reason when they built the house, and so we're having some of the pipes freeze. And I'm going, great. What am I? There was no insulation. This was in Tennessee, yeah. So let's talk before we go into the more of the properties aspect. Let's talk about some of the other types of turnkey type investments. So there are investment companies, and we do this, obviously. So take it with a grain of salt. Don't believe me all you want. That's totally fine. I'll try to help as much as I can. But I remember sitting where you guys are sitting, and I still sit there a lot of times. And as I listen to the speaker, my mentality slowly gets better and better about that speaker. But in the beginning, I'm looking at him like, you're full of it. I don't believe a word you say. So I understand. It's no problem. You take it with it what you want. Hopefully you guys get some value out of this, whether you're working with me or working with another turnkey provider or other types of investments. There's different due diligence you want to do on different turnkey type investments. So one of the ways I would say there is a turnkey investment or one type is in promissory notes. So I really love promissory notes because of the passive nature of them, and also because you can have collateral without having to deal with the headache of the property most of the time. If you have a problem, that's when you have to deal with the property, okay? And those problems can be mitigated by making sure you understand who you're lending money to, making sure you understand what their incentive is, how much money they have into the deal, what your loan to value is on those deals. But a lot of times if you're going and buying a promissory note yourself and you're getting the monthly payments on a consistent basis, you're having to manage that, make sure you get your payments. You're having to go through and, if there's ever any late payments, you're having to call that lender and say, hey, you going to give me my payment back? If you had a foreclosure issue, you'd be the person that has to go through and say, hey, closing attorney or title attorney, let me go and file the file for foreclosure on the property, and dealing with all of that headache after trying to collect as best you can. So, on one standpoint, a promissory note can be timely if you have problems with it, but if you have no problems, then it can be very passive. Now, there's investment companies like ours that are set up as servicers, and there's other servicers out there too. They can do a lot of these collection things for you. So a lot of these servicers will charge you money to do the foreclosure and all that kind of stuff. I like to do that stuff in-house because I have personal relationships with my people that I loan money to. And so when we deal with private investor capital, we go through and help lend their money out to other people, where we'll lend it first and then borrow money against our promissory note as collateral. So then that way, it's more of a turnkey, done-for-you type investment where you're not having to deal with the end borrower. We're dealing with that. We're making a spread on what we're lending and what we borrow consistently from investors, and that's how we get paid. And we get paid for doing all that extra work involved with those processes and procedures, and make it much more of a turnkey investment. No matter what happens on the back end, if we're getting payments or not, our investors are still continually getting paid. And so finding, you can do the work yourself, make the extra spread, make the extra money, which means you got to find the deals yourself, you have to analyze the deals, you have to know how to do the due diligence yourself, and all of that in between. Or you can do something where all of that work is done for you, the servicing is done, any collection issues is done, all the paperwork is done correctly, and you know it's done correctly, and we have taken it to our attorneys and things like that, where we go through and utilize other capital like that for promissory note type investments. So that could be a turnkey type investment as it relates to real estate in general. Another turnkey type investment could be a syndication investment, which a lot of these syndications or funds is where who knows what a fund is? Okay. And so a fund is, there's a lot of people here that don't. A fund basically is where you pool a bunch of private investors' money together, and you go buy a large asset with that capital. So normally there is a manager involved that is managing the overall investment and doing all the work for it. They're getting the financing. This might be, call it a multifamily or a self-storage or a mobile home park fund or something along those lines, right? Say it's a multifamily and I have to go, I'm buying a $5 million multifamily and I need $2 million in actual equity to go buy that building. I might go create an LLC. And then go through and put a private placement memorandum together. It's called a PPM, which is basically the kind of legal business plan or legal documentation about how the overall investment works in detail. And then you also have an operating agreement. So we have the PPM, the operating agreement. Operating agreement actually governs the entire LLC and says what that manager is allowed to do or not allowed to do. It says you're only going to be able to borrow at 75% of the value of the property. You can't go at 85 or 95%. You can't go and take extra money and go buy other assets with it. You can't. There's a big list inside that agreement that says this is what you can and can't do. And that's the operating agreement of the LLC. Okay? And then you have a suitability questionnaire which says, hey, are you guys smart enough to be investing in these? Do you have enough experience to invest in these types of assets? And if you lost your money, is it going to completely destroy you financially, basically? That's what this investor suitability requirement kind of outlines. It's a list of questions. Some funds only allow accredited investors, and some allow other investors as well. An accredited investor is someone that makes $200,000 a year or more for the last 2 years, or has $1 million in net worth excluding their primary residence. So some funds only allow that accredited, some allow everybody. Okay, but most of the time they all have to be sophisticated enough to be able to invest in it so that they understand what they're getting into. And what happens is you're relying on this operator to do all the work for you. Okay, you're going through and saying, hey, we know you have 20 years experience in multifamily deals. You're going to get the financing for us. You're going to go and run the investment with your teams, with your management in place, with all that stuff on the syndication side. And I'm going to invest with you because I've done background checks on you, I've done criminal checks on you, I've gone through and talked to your investors to make sure that they are all happy with you and they've gotten their money back and things like that. I've gone to the market to check out the property that you are interested in buying, and now I'm looking at investing with them. But what am I giving up? I'm giving up control. I'm saying, hey, here's my $25,000, $50,000, which usually that's what the minimums are. Even if a $2 million capital raise, most of the time the minimums are $25,000, $50,000 from a private investor. So invest in that. But what you're doing is you're buying shares of that LLC that own the property. And what happens is basically I'm putting up $25,000, $50,000 as an investor, and I'm giving up control to that manager and saying, okay, I'm going to let you manage the whole project and do everything involved. I really don't have much of a say in what happens, and there's like a list of 5 pages of risks in every one of these private placements that basically outline all of the problems that could occur, including, hey, this operator could drive to Mexico and you'll never see him again. He just took everybody's money. Or they blew it all in Vegas. That's a risk, right? So they have to disclose everything, whether you think that's going to happen or not. Now, at the same time, so you're giving up control to be passive and diversify into a bunch of different things, still take advantage of the lending that is available from these managers that are getting these commercial loans, and you're not obligated for that loan either. You're only at risk for the money you put in. At the same time, the reason why I'm comfortable doing that and giving up the control is because I can go through and do all that homework up front on the investor that is doing this deal for us, and being able to go through and trust them that they're going to do a good job and what they're doing. And that's because I've done my homework on them. I've done those background checks. I've talked to those other investors. I've done a ton of homework on that deal to feel comfortable. And at a deal like that, you're much more dependent on the operator. So the operator is much more important than even the deal in himself. I've seen some really, really bad financial projections and things like that on some of these syndication deals where they say, okay, yeah, it's going to keep going up in value. Rents aren't going to rise, but we're just going to be able to sell at a lower cap rate in 10 years, which that's BS. That type of stuff, you want to say the only reason why the cap rate is you're going to be able to sell it for more is because they've done forced appreciation. They've been able to raise the income level to be commensurate with that sales price, okay? Because these large multifamilies, for example, sell based on how much income they produce. So you're looking at, like we work with an operator that does self-storage, for example. They come in and they buy these self-storage facilities from mom and pop shops, and they'll come in and they'll go and add U-Haul trucks, and they make a deal with U-Haul and add additional revenue there. They go sell them locks and boxes and sell them insurance and get a kickback from the insurance. And then they'll go and increase rents or add additional units. And so this operator specializes in doing that and has been doing it for 20 years. And so we invest with them because they do that aspect. And we've already invested with them multiple times and gotten our money back and things like that. So we've seen the whole process happen. But this is an example of another turnkey type of investment where you don't have to do a ton of work other than your upfront homework. No turnkey investment stops you from having to do your upfront homework. Yes, you can rely on the team members a little more because you're dealing with more professional investors that know what they're doing. At the same time, a lot of people are full of it. You have to do your homework. You can't just rely on what they're telling you. You have to verify these things and make sure that you're protected. Don't ever just take what someone tells you. Take what someone tells you and then go back it up for yourself. Do your own homework and make sure you understand what they're saying. Okay? So we have, the promissory notes and the syndications are two other types of turnkey type investments that we deal with consistently. I invest in these things myself too because there's only so much active work you can do yourself. You have to invest passively as well once you start having enough capital to do so. And if you don't have time to do a lot of this other outside work, being active yourself and being a flipper yourself or finding these deals yourself, then a turnkey investment might be the way to go because you don't have that time, and otherwise you also don't have necessarily the expertise to be able to do all that work, or the team member to do all that work for you as well in the process. Okay? So any questions so far? Everybody kind of understand what I'm talking about with those other two, the promissory notes and the syndications. Everybody's got their mouth full, so, you know. So, okay. Yeah.
I started dealing with a turnkey company in New Jersey, and it's kind of like I hear what you're saying about having to do due diligence, but here's the problem that I'm running into is that like they sent me a property to look at, and I said, you said you rehabbed it, but you didn't tell me what you rehabbed. I don't know. I'm not seeing what the work has been done. You're not telling me what your fee is to do this. All you're basically giving me is how much the property is, how much it rents for, how much property taxes is. And they're like, well, I don't have that information. They didn't give me a pro forma.
Yeah.
They're like, well, you know what? Someone already bought the property. You don't want it. No big deal. So you don't have the opportunity to do that due diligence. So because you're running into property or turnkey managers that just go, well, you either want it or you don't. So how
So the thing is, okay. So one, right now there's a substantial amount of demand. So these properties are flying off the shelves if they're finding good deals that are positive cash flow. Two, you can still do your homework after you get it under contract. Okay? So as long as you put in the contract, you have that due diligence period to go get your homework done. Now, your homework, if they don't have that information for you, and this is the problem with a lot of turnkey providers, is they don't provide that information up front. So it makes it so that it makes it much harder to be able to do your homework on a deal. And so in the contract, you're going to go get an inspection done on that property. And on my inspectors, I ask them to tell me what they think the estimated age is on all of the major systems in the property. The plumbing, the electrical, the HVAC systems, the roof, the foundation, you know, all the water heater, all the appliances. I want to know the age of those things because those are the things that cost you money. And that's one of the biggest problems with turnkey providers is they don't do that stuff. They go put lipstick on it and they say, okay, it's going to be good and up and running for a couple of years, but hopefully that roof it doesn't have any leaks, but it really is going to need to be replaced in 3-4 years or 5 years. They don't care. They're just going to go through and say, here, go ahead and take it. It doesn't need the work right now, so they're not going to do it because they're going to line their pockets with that extra money, which is understandable given the climate right now, but at the same time, it's not good business practice to do that. So what we do on all our stuff is we go get a full inspection report. We get side-by-side pictures of everything in that inspection report showing it's done. We give them full financial projections. We give them the full renovation bid, room by room, item by item, which breaks everything down as to what we did on the rehab. We also do a disclosure checklist as to the age of all those major systems that I discussed. And if we've checked them, if they look good, you know, what issues came up and what issues are done. And that is really, if you're not getting that from the turnkey provider, that's what you have to do yourself. Is you have to go get that inspection. You have to go and say, okay, well, this water heater is 10 years old, and so, you know, nowadays they only last, 15 years max. Right? They used to last 30, but now they only last 15, or 10 sometimes. And so those are some of the issues that you want to go through and say, okay, am I comfortable buying this property, even though I see $5,000 worth of stuff or $10,000 worth of stuff that's going to come up in the next 5 years or so, or the next 10 years or so? Does it still make a good, viable investment? And if those things aren't done and they say it's turnkey, ready to go, you can go back to them during your due diligence phase of the contract, which is usually like 15 days or 14 days, and say, hey, look, in the inspection report, this water heater is on its last leg. The plumbing is 1930s or whatever the heck it is. The line to the street's probably bad. You can say the roof is on its last leg, and you come up with a cost estimate for all those items and say, look, I can pay this for it. This is what I can pay for it. Or I need a credit for some of those items. Or maybe it's a good enough deal for you to buy as is, and then it makes sense to do that, So those are the things that you do during the contract period. So you get it under contract first, because then they know, okay, you're serious. And then you should be able to do your due diligence during that period. Okay?
So it's pretty standard then for turnkey contracts to allow for that? Because that's what I'm afraid of. That's why I haven't bought anything, because I'm afraid, okay, once I get this under contract. They don't explain any of that to you, what their contracts read like. And so, yeah, you've done an inspection and you told me that the water heater has 10 years, but how do I know? I've never done business with you. Am I allowed to say, I want to bring an independent inspector and have my own? Because that's the only way that I'm going to know that I can trust you and I can do business with you.
Right. Absolutely. And that's so I would absolutely do that every single time, especially if they're not providing you with an inspection report and things like that from an independent contractor or independent inspector, I mean. So I wouldn't buy a house otherwise. So if I'm going to a brand new turnkey provider I know nothing about, I'm doing the inspection myself, or I'm getting a re-inspection from their previous inspector if they've done it, and I want to see all those major systems. I'm going through and I'm analyzing the market in a lot more detail as well, because there's different levels of turnkey providers. Some turnkey providers provide the low-end asset class that the tenant base really is horrible, and it's going to eat you up down the line, where more turnover, more bad debts, and things like that when you're owning rental property, And so that could be a big problem down the line that you want to mitigate and only buy in certain segments of the market. And so not all turnkey providers are built equally, okay? There's different skill sets when it comes to not just providing properties like that, but the management piece afterwards. So, it's one thing up front to make sure you're getting a good deal and analyzing the numbers on that deal as much as you can, but it's another due diligence step to make sure that you understand who the manager is that's managing that deal, because that management is everything. That will destroy you down the line. Even if everything's cool up front and you have a couple minor repairs that you need to handle or whatever it is, and they could be completely honest too. And then they could just be really bad at property management. I know people that, there were turnkey providers in Indianapolis, for example, that were telling me that, hey, they're going to lose all their buyers because the management is just so bad. They had to go and set up their own stuff and deal with that whole headache as well, So, I mean, the management is everything when it comes down to the end product, So that's really, really important to focus on. I'll go over some of these different things as far as the management piece, and we'll talk about that. Some of the things. So you had a question here?
Yeah, is there a minimum grace period by law that you have?
No, it's in the contract. It's by the contract, right? It's not a law associated with it. Yeah.
So we could say 30 days for. What is the usual time?
So usual is 14 days. Okay, if you do 30 days in this market, the provider, unless they just are cool with it, the provider is going to be like, yeah, that's a long period of time. Cut it down to 14 days, and they're going to have that in the contract. And those other turnkey providers are probably going to provide you with their contract because they have all that. So read those contracts, understand them in detail, so that you know exactly what you're buying. And what what your rights are. You can absolutely. So normally there's like financing contingencies, meaning if you can't get the loan, then you can cancel the contract and get your earnest money back. If there's an appraisal contingency, or there is a inspection contingency, these are the typical contingencies that you see where you can get out without a problem and get your money back. So without an issue. Now you won't get your inspection costs back. That's paid for, that's maybe $350 or something like that. But honestly, getting an inspection report like that and reviewing it for the first time is something that you should be doing anyways, and it's worth the $350 just for the education you get by reviewing what these inspections look like. And you want to get an inspector that not only will go through and give you pictures and written descriptions, but will go through it with you afterwards and explain what they see, and also kind of help you get an explanation of what they think that cost might be. So a lot of inspectors, on their inspection report, maybe they review the HVAC system and they say, look, I see some issues with it. I'm not going to say anything else about it because I'm not a licensed HVAC technician. So make sure you get a licensed HVAC technician to go out there and take a look at it. Every single time the inspector is going to say that. And so, because they're not going to take the liability on if something breaks and they say it's good for you. Okay, they're going to give you an estimated age. They can do that. They can tell you that they see what is wrong, and then when you talk to them afterwards, that's when you can go through and say, okay, what do you really think about this HVAC system? Is it on its last legs? And that's when they'll tell you this thing's about to be done, or no, it's actually brand new. It just needs to be serviced, from what I can tell. Then if that happens, that's when you want to go through and get an HVAC guy out there to do a secondary check after your inspection happens. So, and they're going to do that on furnaces, HVAC systems, roofs, plumbing and electrical, all the major systems. And so you're going, great, well, what the heck is good? What are you good for then? I got to get all my contractors out there to really take a look at the system, So we know based on our experience what issues come up and how much things cost. To do, and we know we have our contractors going through every time anyways on all the properties. But if you're new and you're buying a new property for yourself, you may want to have someone that's a general contractor that has a HVAC person, that has a plumbing and electrical person, and a roofer. They can just send them out there and say, hey, do me a favor, I'm going to pay you $100. Can you send your guys out there and just do a check on these items, So as after you get your inspection, okay? So, and that will help you kind of give a determination of what these things might cost to fix after you go through it with your inspector. So you should, as soon as you enter that contract, you order the inspection. They usually get it back to you within 3 or 4 days. It might take a full week sometimes to get everything back. And that means you only have like another week, right, to go get it done before you have to say, hey, this doesn't work for me, or I want my money back, right? Then as soon as you go through that, you get that inspection report back, you go through it with your inspector right away. So then that way you have enough time to go send your general contractor out there to take a look at those items that he said, hey, I'm not going to take liability on for, So, but there may be some issues, like I mentioned on the HVAC system, where the inspector says, yeah, I put it in the report, but it's really good. It just needs to be serviced from what I'm seeing. And maybe in that case, it was a 2014 unit or something. It's 3 years old, and you're not too worried about it, So, so those are the types of things you make that judgment call at that time after you review the report, And so you have to be really good at reviewing those inspection reports and coming up with a cost estimate of what those things might cost you to fix. If there's $5,000 or $2,000 or $10,000 inside that inspection report of things that are wrong, then you want to be able to determine that up front before you go and close a contract. And so, and before you get out of that contract, if you say you see too much and you're like, I want out, you actually have to give them a written statement saying you want out of the contract. You don't want to be verbal at all. You want to be able to send it back to them saying, I'd like my earnest money back. I'd like to enact my contract, and usually do like an addendum or something like that to tell them you want out, So, okay?
Can I have a little question?
Yeah, no problem.
I don't want to take
No, please, it's no problem at all.
Okay, so there are a couple of different turnkey companies also too. Like there's one that does, like what kind of property are you looking for? A duplex, a single family, a fourplex, whatever. They go out and they find something for you. They tell you how much it's going to cost. And
It's the most efficient way to do it, right?
Yeah. Then they tell you how much the rehab is going to cost.
And they do it all in your name. Then I
Exactly.
assume.
You do it all in your name. So you get all the write-offs, you get all of that. So there's that kind, and then so when it's that way, do you wait to do the inspection until the end, like the final inspection, or do you do it in the do you do it to see if what they're saying needs to be done is the same thing that needs to be done?
Yes, because they're going to go tell you, hey, they're going to say it's going to cost $15,000 in rehab. So for you guys who couldn't hear possibly, she's asking, there's two different types of turnkey companies, and some of them do both strategies. So we do both strategies depending on the person involved and that kind of thing. So one strategy is you sell it to the investor up front, or you buy it up front before renovation happens. You rehab it in your name. You go through and get it rented, and then typically refinance to pay off like short-term loans, or if you brought it all cash or something like that as well. Okay, so the other strategy is it's done, ready to go, rented, renovated, everything's done. Okay, that's a much easier to go get your inspection on and have that, make sure that's taken care of. But either way, I would go get an inspection done up front. If you're going to buy it before rehab, I would get that inspection done up front to make sure okay, these are all the things that they're saying needs to be done. This is the major systems that I see that are messed up that need to be fixed. Is everything on that bid? and where are they coming up with their numbers on that side? Because there's totally different levels of rehabs. You don't want something that's going to break on you a couple of years down the line, and then it's going to cost you a bunch of money. And it's going to destroy your cash flow too. And so it's basically upfront cost that should have been put in that wasn't. Is what's happening. And so when you're doing these types of strategies, I think both are great. Now, so the benefit of having it done already is that you don't have that construction risk, right? You still have to get your inspection report, but you don't have that construction risk involved. And, what if there's overages? I mean, that happens quite often, Like I'm under or over by $5,000 on a bunch of different deals all the time. It depends on what they find in the property afterwards. And we put buffers in place too on everything. And so in your bid, if you're going to buy it that way, unrenovated, make sure there's a rehab buffer in place. Make sure you cover your closing costs. Make sure you cover your utilities costs, your inspection costs, your interest costs if you have them. So all those things are now on you, and there's some construction risk, but a lot of times you can get a little bit better of a deal because that person that is buying it for you specifically doesn't have interest costs. They don't have as much overhead costs associated with buying this thing. All the utilities are not on them now, it's on you now. So they're pushing some of that stuff on you, but a lot of times you can get a little bit better of a deal. And if you have your own cash too, you can even cut down the interest as well, because during a renovation project, say it takes 3-4 months to get it renovated and tenanted. Normally it should take 2 to 3 max. But if that's the case, if it's 4 months from renovation to tenanting, then you have 4 months of interest, and it's $100,000. It could add up. It's a couple $1,000 at least. So looking at that cost savings versus how much of a risk you're taking on the rehab side, I think is important. So and you want to be able to analyze the market value much more effectively on those properties too, because when you're analyzing, you want to know that after you rehab it, then you can refinance it and get your money back, or most of your money back as best you can. So you're now doing your financial projection on total cost as well as after refinance to know where you're at on that side. Make sense?
Yeah.
So and there's headaches that come up when you're buying with turnkey companies. So like. Sometimes there's nothing you can do when with these different problems that come up. Like literally every single time not every time, probably 85% of the time, a new tenant moves in after a brand new renovation is finished, and there's always 2 or 3 little service calls. Like we had one recently where the tenant emailed us and said, "Hey, we have all of our service calls online." They said, "Hey, we were living in the property and there's no exhaust fan in the bathroom." And we're like, "What do you mean there's no exhaust fan in the bathroom?" And our guys doing 10 houses a month just missed the exhaust fan in the bathroom. And so we went and said, "Okay, we're going to go take care of it." And we put the $200 exhaust fan in. It was not a big deal, right? But we expect to have, $500 to $1,000 of little things that happen after move-in. So you want to be able to go, if you're buying it unrenovated, and allocate for that. We go through, when we do turnkey sales, we cover that stuff. Some providers don't, they don't go through and deal with that mess. We go through and we allocate on every sale $2,000 as a reserve on every house that we do for these little problems that come up after the fact. The reason we do that is because it makes our investors happy. Like I just sold a package of like 11 houses to an investor, and one of them went vacant right afterwards. We just covered it. We're like, look, cover the rent ready, make sure you continue to get your rents. And it cost me like $4,000, right, total, because it was a higher end property. We're going to have to go get it rent ready and get it re-rented. It's like I think it was like $1,500 in total rent ready costs. After move out, and the deposit basically was like $800, and then so we got some of it back, but then it cost me a chunk of money. But at the same time, I didn't have it on the other 11, and I put that $2,000 reserve aside on all those other houses. And so, but my investor's going, "Oh wow, I didn't tell them I was going to do that. I just did it." But that's the type of operator that you want to look for in multiple markets. Is what do you do if something happens after the fact? Do you have any kind of warranties or guarantees? Or how have you handled it in the past? I had just recently, I had a client that bought a house from me 7 years ago, and The tenant was in the entire time. And it came up to be over a $5,000 rent ready on that rehab, because they had to repaint everything in the house, because it's been 7 years, Usually useful life of like any kind of carpet and paint is like 5, So if it's been 7 years and you have to recarpet is like a couple grand, repaint is a couple grand, right away. So it wasn't substantially bad, except for the fact that the tenant didn't tell the property management company at all that, hey, when they're walking through the house, the subfloor was substantially damaged by termites. And so it was like another $8,000, $7,000. And so I'm going, great, I don't know if the termites were there 7 years ago when I sold it, to them. It could have been, and I just didn't know, but at the same time, so we just covered it. We're like, look, I'm going to cover it for you, which normally I wouldn't do this 7 years later. But in something like that, when it's a giant cost and you already got hit with $5,000, worth the rent ready costs, I'm like, I'm not going to go let you take another hit on top of that. And I do it when I can. It doesn't happen very often. Those types of things happen like 3% of the time probably or less when you have a major issue like that. But at the same time, you do what's right and you try to take care of people. The guy's going to buy another house now. So because of that. And I'm like, awesome. He had no problems for 7 years and it was $5,000 of stuff, Plus he had a security deposit, so he'll probably get like $1,000 back from that. But, these are the types of things that you look for when you're dealing with, how is that turnkey operator going to perform when things hit the fan, when there's issues, you know what I mean? So that is, I think, really, really important. And so here, let's go over some of the benefits of working with a turnkey company. And these are also things that if you're going to do it on your own, you should really understand yourself in a lot of detail. And look at it as, do you have the time to do it? Is it going to be worth it for you to do this in the first place? So like one of the things is, the local market knowledge, understanding the area. Now in the beginning, when you're first getting to know somebody, you don't know if they're full of it or not. They might say, hey, this neighborhood is cool, this is perfect, but it's really the hood. I had a property manager one time that I trusted, okay? Found out afterwards he was a drunk and totally screwed us a lot of money, but not substantial to where it was going to hurt that bad, but he had, problems. But he was telling me, oh yeah, this property's cool right here, and I didn't see it. I was like, okay, I'm going to trust you on it. He showed me some pictures and things like that. I saw the pictures and everything. I'm like, okay, cool. And I got the inspection. I did everything else, right? And then I go by there, and he after I bought it, he took me during the day on a weekday, and I'm like, okay, it's cool. And then I went there at night, on Saturday night, and there was crackhead. I'm like, oh crap, I was like, I don't know what to do with this house. I got to get rid of it, I mean, the only paying tenant was a dude that was dealing herb out of his house. He's sitting there, and it's funny, you can tell they're doing it because they have storm doors, and then one of the pieces of glasses from the storm door is out, so they can just sit there and pass it through and have it locked the whole time, and you're like, I don't know why I know this now. It's just horrible that I know this stuff now. But this is the type of thing that happens, and I'm glad it wasn't crack, but at the same time, I'm going, well, he's paying his rent. I hope I don't know about it for right now, because I got to have some rent coming in, somehow on this, because the other tenant wasn't paying. But that's an example of a low-end house, that has a problem, and you're like, great, another problem. How do I deal with this, right? So,
is that what you consider a C or a D? Or is a C
that one was a D minus.
Okay.
So I will buy in C neighborhoods, but you want to look at the surrounding streets as well to make sure those are not Ds, or it's not getting worse a couple streets out. Just because one street is decent doesn't mean the neighborhood is decent, and the neighborhood really matters for crime and things like that. Analyze the crime rates in specific pockets and what types of crimes exist and things like that. I think that's important to understand that market, know where your bad neighborhoods are, and find a outside party, preferably not necessarily a realtor all the time, because the realtors want you to buy a house, right? So there's a little bit of a conflict of interest there. But at the same time, there is some really honest realtors and other honest team members you can find that will sit down with you and go over an entire map of the area that you're looking for and say, look, I don't want to buy the low-end stuff. I want to buy decent stuff where I'm going to get good tenants. where would you buy if you're buying a property, and where would you stay the heck away from? So in addition to the turnkey provider that is telling you what they see, there's still a conflict of interest there, right? If they have a low-end house, they're going to be like, it's not that bad, don't worry. Of course. So, but, the only people renting that type of house might be a Section 8 tenant, and I don't like dealing with Section 8 because of the headaches involved. I mean, you have to go through and rehab, you have to go and fix $2,000 worth of stuff every single year because the inspector comes out and looks at it and the tenant caused damage. The tenant is, you can't, they're judgment proof because you can't go after them because they have no money. So like, I'm like, unless you have a big security deposit, and you have additional income that I can go after if you destroy my house, I don't want to deal with a Section 8 tenant, So the local market knowledge, I think, is really important, including rural areas. Also certain pockets of the city might have different city issues. Maybe there's a big assessment that's coming, a tax assessment that's coming in that area, or they have a higher tax rates in certain segments of the market. There's different things like that could exist. Or maybe, we had an area that was having a ton of plumbing issues in that area because there was a lot of ground movement and things like that. And the actual ground in that area was more softer. So, we're having issues like that, or the city might have major plumbing issues where they have to go redo all of the, sewer lines and things like that, which could cause problems down the line. So those types of things could happen. And so you want to understand the market in a lot of detail. And a lot of these turnkey providers know what to do and understand that piece of it, So that's one thing. The renovation expertise is also really important that most turnkey providers know. And don't get me wrong, when I'm telling you guys all this stuff about turnkey providers, you still have to check to make sure that they really do know what they're talking about, because they could know 10% more than what you guys know, and it sounds great. I've been totally gamed up by different property managers that ran renovation companies. I'm driving around with them, and I'm going, these guys know their stuff. They really know their stuff. And I was all excited, and then they stole $50,000 from me. And I was like, and then I found out they were doing a presentation on ethics afterwards, and I think I mentioned this in my last PB event. And I was like, great, just turn the knife a little more, and I was going to basically spend $50,000 in legal costs to try to fight this and get this money back, So, and I messed up in the beginning. I didn't have detailed contracts in place for the construction, which I do every time now, after losing $50,000 on that. I'm like, that was a multi-family unit where the walls they said all the plumbing was done, and they did none of it. And I was like, they turned the water on, and the walls just bled water. And you're like, and the building was built in like 1915. I'm like, how are you going to not do the plumbing? You're crazy. Like, what is up with that? And I was just like, oh, you're going to rehab it. Great. Go rehab it. What's the cost? And they kind of gave me a general breakdown of the cost, but, he totally got me. Like I didn't know what I was doing in the beginning, So my first rental property that I ever bought was negative cash flow, $500 a month. So I totally took my own hits with this stuff and learned my own lessons. So, but the renovation costs are really important, and you should understand that in detail, what these major systems cost, and outline them in detail to where you're saying, okay, a new roof is X, AC system is this, a furnace is this, all the plumbing redo is this, all the electrical redo is this, and you divide it by the useful life left, and then you should be allocating some money for that on a consistent basis for each of those major systems that might need to be replaced 10 years down the line. So allocating that kind of stuff is, I think, important.
One quick question.
Yeah.
What you say you did the cost, the estimated cost of let's say it's an HVAC system, and then you divide it by the remaining useful life, and that's kind of how you factor in.
That's how you say, okay, and sometimes if the remaining useful life, like if I have an AC unit, for example, has 5 years left on it, and I'm going to hold it myself. If I'm selling it, I typically have to go through and just do it, and get it taken care of. But if I'm going to hold it myself and I'm going, you know what, I'm going to see how much useful life I can get out of this thing, but I'm going to go and allocate, $4,000 or $3,500 up front and put it in a reserve account because I know that thing can go out at any time, so that way I know I have that put in place for that type of stuff down the line, So it's either, if it's coming soon, you may want to put it all up front. If it's going to be 10 years down the line, take a small piece out of your cash flow and put it aside for that kind of stuff. I mean, sometimes, like we rehab our stuff where it's going to have at least 10 years of useful life left on everything. And so a lot of our investors, like we haven't had any major issues with this stuff. if we messed up and our roofer missed something or something like that, we'll go replace the roof afterwards for our clients. But at the same time, you want to make sure that you're reviewing all that stuff too. Okay? But a lot of these outside turnkey providers have that understanding, know what the costs are, and can break them down to you and say, how much is a new HVAC system? Have them break down the major systems that might need to be replaced in the future. So that will actually help. And there's no real reason for them to lie to you on, if you're just asking these types of general questions on how much certain things cost on a rehab. Okay? But gain that understanding yourself, because that will not only help you with your own investing, but it'll help you, when you're flipping a house, and the way you analyze a house changes substantially when you understand the costs. Okay, let's see. Preventative maintenance is actually really, really important too. So our property management company provides, and our outside management company that we use as well, provides AC filters for the tenants, for example, because they're never going to do it themselves, or they're never going to go and buy the AC filters to put it in. They're supposed to be every month changing the AC filter to keep the life of the AC unit as long as possible. But, tenants don't do that stuff. So you got to go out there and sometimes check and make sure and hold the tenants accountable to say, look, you didn't change the HVAC, you didn't change this, now it has to be serviced, we're going to bill you for this. And have that communication up front with the tenants. Because if it's in the lease that they're required to change the AC filters and they don't do it, then that's their bad, that now you have to go through and do a big maintenance, servicing on that HVAC system. So it's a lot of this preventative maintenance stuff can be pushed onto the tenant as much as you possibly can, within reason, of course, and requiring them to keep up on it. But then you should also do like an annual review of the property, to be able to say, hey, what tenant damage is there? What preventative maintenance items look like they might be coming up now that they've been in it for a year or something, and that way you can up front counteract some of the issues that are going to come up consistently when you own rental property. And you want to do that with every unit that you own, so that you can also push some of these things onto those tenants, and much more effectively if you're communicating with them up front on an annual basis, saying, look, there's 5 items in here that, were not like this when you moved in. Can you get these fixed within a couple weeks? If it's a couple scuff marks in the wall, you're not going to do anything. But if it's like someone got mad and punched a hole in the wall or put their doorknob through the wall or something like that, then you're like, hey, go get this fixed. You got a couple weeks to get it fixed. I'm going to come back and inspect, or otherwise we had to do it ourselves and charge you for it. And you want to do that consistently as they live there, because once they move out of that property, it's a lot harder to collect from them than if you just charge them $100 for a service call up front while they're living there. So just to keep all that in mind. Okay.
What is the annual inspection time that you normally do? Like, is it quarterly or?
Usually on an annual basis. We'll go through and do that. She said, what is the normal inspection time that you normally do when you're doing that preventative maintenance check? We usually do it on an annual basis or something along those lines. So.
And that would be in the contract, right?
That would be in the lease agreement. Right. Well, and you have a right in most states to go through, and I don't remember the exact rule here in California, but in most states you have the right to go and inspect the unit with a 24-hour notice. So normally we'll try to schedule it with tenants, and some tenants are like, oh yeah, I'll be there, and they never show up, or they go through and never return your calls because they know there's damage or something like that. And so in that case, if we're not able to get a hold of them over a month period of time, then we'll go and say, okay, fine, we're going to go post a 24-hour inspection notice. We're coming tomorrow. I don't care what you say. We're coming in the house. So these types of things happen sometimes where tenants just don't communicate. Like sometimes, like we have one tenant that's a truck driver. You know how hard it was to get someone into that property in order to just do an appraisal on the property? I mean, it took a while, because they're out of town constantly. So, okay, property management experience. Actually really, really important, okay? Who here has owned a property that had a bad property manager? Okay, a couple guys here. Nice. So you know the headaches that you deal with. I mean, some of the main things with property management are tenant retention, you have a tenant retention issue, where you want to be able to constantly keep them in the property. You have the tenant selection, initial tenant selection, which stops a lot of issues up front. Okay, you have accounting. You have how do they handle delinquencies? How do they handle leasing and marketing? How do they understand the tenant landlord laws in the area? What are and how do they deal with preventative maintenance? Not all these managers are created equally, but a lot of these turnkey providers have this proven system set up where they've gone through those headaches already. They've gone through the learning curve of how to manage a property effectively. Now they're not all created equal either, so you want to be really, really careful because you could have a newer turnkey provider that has a great system on the purchase and sale side, but then doesn't focus at all on the property management and says, okay, yeah, it's on them now, I don't care. And then they just have a really bad management company set up that, the communication is really where it starts, both on the tenant side and the owner side. And if they're not communicating with you correctly and getting back to you correctly on the items, that's when you have more of an issue. Okay, and a lot of times it's because they didn't take the action that they should have taken, a month ago on a tenant that they should have evicted or something along those lines. The communication really, really is important. And what we do is we'll go, and I learned this from one of the other For Investors, By Investors leaders, Christina. What she had done, and I started doing it, is every week I'll go and I'll send a question, a Q&A to the property manager, and and if I don't hear back within a couple of days, I'm sending a follow-up email. If I don't hear back within a couple of days, I'm doing a phone call. So you want to make sure that you are stringent and push really hard on getting that communication from these property managers. Some of them are managing thousands of properties. It's a big headache to do that, and so they should have people in place that handle that communication. On the accounting side, you see a ton of errors, in different ways from bad property managers. Even really good property managers are going to have an error every once in a while. If you're managing, 1,000, 1,500 houses, there's going to be an error here and there that they're not going to catch. It got allocated to the wrong house or repaired it or something like that. You want to go and also look at, and as part of managing the managers, hey, I replaced this water heater last year. Why am I having a service call on it? Or why is it being replaced again? And so those are the types of things that can happen where you're like, oh, they totally built it to the wrong property. It should have been over here. And so that would have never been caught if you're not paying attention, and someone else didn't get billed for that, but you did. So there's issues like that. And so you want to make sure you really, really analyze your accounting statements in a lot of detail. Okay? Questions on property management? You guys should have tons, but okay.
I have a question.
It's the hardest part.
In terms of property management, what do they look for besides like a strong FICO score or a history? How long they've been in other residences when you look at a tenant?
Okay, so you're talking all tenant selection, which stops a lot of the major issues up front. Okay, so one. FICO score is not always the most important thing, okay? Income is the most important thing, and verifying that income is the most important thing. They need to make 3 times the rent. If they don't make 3 times the rent and they're close, a lot of times it depends on, it's an overview of all the factors, right? Maybe they have a good FICO score but don't make quite 3 times the rent, but they're almost there. And in that kind of a situation, we might still approve them, but then we'll require like a double security deposit or something like that, involved. But it's very subjective, and so you look at FICO score and you say, is there any judgments? Is there any evictions? Is there any other major issues that show up on their credit score? But you're looking at their nature. Do they have a bunch of outstanding balances with multiple credit cards and their cell phone and utility company or the IRS or issues like that? Or do they have something where, they declare bankruptcy because of a medical issue that happened 2 years ago and they have a low FICO but they have decent income? I know right there 2 years ago all their debt was wiped out. They have no debt anymore. And you want to understand those things, and maybe going forward they have no other collections or no other issues, but they're making good income now. So those are the types of things, you want to look at. Some other secondary checks, if you're unsure, I know some management companies that do this every single time. We do it sometimes because it depends on if we have an iffy tenant or something. But basically, going out to their previous residence to view their previous residence to see how they live at that property as well. One management company I know that does this every time. They said 75% of their large rent readies went away when they enacted that procedure. So, and if they don't meet with you at the scheduled time, then they're automatically disqualified. So they schedule a time for you to go and their house, and if they don't meet with you, then they're out. You know.
I'm sorry, what are rent readies?
Rent readies is when a tenant moves out, and then you have to get the property rent ready again for the next tenant. So so that's like turnover cost, and so you want to avoid high turnover costs as much as possible. And so going and looking how they live in their previous residence is one way to see how are they going to mess up your house. So like I have friends of mine, for example, that I see how they live, and I'd be like, there is no way in the world I would rent to these people, because I see how dirty their house is. I see how they keep up after themselves, and I'm sorry if anybody in here is dirty, so, but we just have stuff at my house. I don't have, it's all clean, but it's just too much stuff, so, but I like renting to tenants that have a lot of stuff, especially when there's a garage, because they stay there longer. They don't want to move all their stuff out, so sometimes getting a bigger house where they can store their stuff is huge, for tenant retention. I think the tenant retention starts with that initial upfront due diligence on that tenant, setting that expectation up front once they're in the approval process while they're signing a lease with you to say, hey, here's all the preventative maintenance stuff that you should be taking care of. Here's what we expect from you on the leasing side. Here's the procedures that we go through on eviction. We go through and let you communicate consistently with us. If you're going to miss the rent, you're going to be late on the 6th of the month, we're going to be sending you an email, phone call, and letter on the 6th, letting you know what your balances are and everything else. And then if you communicate with us right away and say, I'll have your payment in, then great, no problem. We won't file eviction until you don't do what you say you're going to do. And then at the same time, if they don't communicate with us, we're trying to get on the 10th, and then we're trying to get on the 15th, and we don't hear back on the 15th, we're filing on them. So because you want to work with them, and then we even still will tell them too, if we file on them, that we will work with them any way we can to try to get them caught up. We want them to be able to be successful at this and not have a problem with the rents, but we have to have the rents, and then I tell my team to blame the California office so they don't have, they don't get as much hell from the tenants that come in screaming because they're mad that they're getting evicted. But there's some crazy tenants out there. I'm telling you, I feel bad for some of my collection agents because they have to deal with people coming in and just screaming first while you're just sitting there letting them scream until they get it all out of their system. So, but that's when they're late and they're going to be evicted and there's money involved, that's where the emotions are heightened, and that's when the management company has to step back and say, I'm not going to give any heightened emotion whatsoever with regard to this. Does that make sense? Okay.
I have a question.
Yeah.
So do you prefer property management companies for the minor, average, non-rehab type repairs? Do you prefer groups that have their own in-house contractors or sub it all out?
There's pros and cons to both. With the in-house contractors, they typically do a markup on the repairs because they have to cover payroll taxes, they have to cover, trucks, they have to cover tools and equipment, insurance in place and all that kind of stuff.
Right.
So that can be great, except sometimes, if they're not big enough, they're hiring these people in-house and then they have to keep them busy. So they'll okay, I'm going to send them every service call I have to keep them busy. But then sometimes maybe it doesn't need a service call, or it doesn't happen often. But I'm just telling you what's going through the property manager's mind, saying, if I don't have them out on a service call, then it's costing me money, from that perspective. So we have one in-house tech and a bunch of outside subs, and that way on all the minor stuff we can have our in-house tech going and taking care of it and doing the punch list for us, and we also have them doing punch lists on rehabs too for the downtime. So we use them on both sides. So that way we don't have that kind of downtime associated with it. I could have them going and gutting a house if I needed to, you know, and so or doing landscaping if I really needed him to, you know, and putting the wood chips out and all that stuff, you know. But on the other side of things, if you're subbing it out, you have to have a little bit better quality control, and you go through some of these outside subs sometimes where they're good for a while and then they start not communicating, or something happens in their life, or they don't do a very good job. And so on a lot of, like, what we do is we go through and we'll call the resident, call the tenant, and say, hey, was everything fixed? Is everything okay? You know, with this job, is it working okay? And we'll check and see, are we having reoccurring issues with that same thing? And is it the contractor's fault, or is it the plumbing that just really needs to be replaced now, or something like that, you know? So so there's pros and cons. You know, the pro to outside subs is there's less overhead associated with it, but usually their billing rate is a little bit higher, you know? The in-house people, if you're efficient at it, can keep costs down a little bit more, you know? So that's why we do both, because I'm looking at it saying, okay, I want to be as efficient as I can. I don't have a giant management company that I do this with, where I'm dealing with. We have our management company, which is we're running like 300 units out of, and then we have a sister management company that we've been working with for 10 years that has 1,600 units. So, and they do all their stuff in-house. They have their own trucks, their own, you know, workers' comp, their own payroll taxes. They have 401k plans, you know, for their guys. You know, this is what it takes to bring in quality, you know, contractors that aren't going to go do it themselves, you know. So, and a lot of these quality contractors, like you have good and bad contractors on the outside side that are subcontractors that you're not paying as employees. And then you have good and bad contractors that, as the employee side, some of them are absolutely great, but they don't know how to market from a business perspective. So they're not trying to do it on their own. They just want to be an employee, you know, because running a business is hard enough. You know, it's not easy to do that. And so, you know, running a business comes to, you know, marketing, sales, accounting, overhead, managing the overall business, managing employees, you know, managing all these different jobs. It's a lot of work, you know, so to do that. But, you know, so there's pros and cons to each one, though. So, yeah.
Question: when you identify an investment that's, you know, not in California, what kind of indicators are you looking at in that area, like jobs or industry?
Okay, as far as the market goes, so one, you want to look at crime. Okay, you want to look at and you want to look at the different segments of the market for crime as well. Which ones are higher and lower in crime in those segments of the market? And so you can get that information by property managers, from realtors, from crime statistics in the area, police departments, things like that, you know, and get an understanding of the crime in those areas. You want to look at the economic stability of the market. You know, what is happening with the job growth in that market, with the net influx of, migration or outflux of migration. What issues are happening there? What's happening with the job market in that area, and the employment in that area, and the government in that area? So is the government very pro-business, or are they, siphoning money like most governments do? So I'm not going to get into that. I almost wore my taxation is theft T-shirt for you guys today, but I left it alone. So, So when it comes down to additional market factors, you want to look at, is it a rural area? What's happening with the housing price index in that area? Has it gone up consistently like crazy, or does it slowly, steadily rising and slowly, steadily dropping during times of economic volatility? That's one of the reasons I invested in Memphis, was because it had really high cash flow, and on average it goes up about 4% a year. So when you're dealing with, and when it goes down by 2 to 4%. So you're not dealing with a major volatility like some areas here in California, and if I'm going and flipping or holding out there, I could be in the middle of a bunch of flips, and my cash flow, as soon as they're rented, they're paying for my debt payment either way. Out here, I could be in the middle of a flip and I'm negative cash flow. I can't rent it and break even. So if the market crashes, which it goes down faster here, and usually California is the market that goes first, and then you have other markets that follow, then in that case, I could be underwater and negative cash flow and in a really bad position to lose money. Out there, I might be looking at like a 5% drop in values. If there's a major economic issue, During this last crash, it went down by 4 to 6%. There was some small markets for a short period of time that went down by like 10, but then it bounced right back, and it was more of a liquidity in the market type issue. But out here, they dropped a lot, and so I can be much more stable in a market like that where my cash flow can sustain me, and I can just sit there and wait and buy new assets at the lower prices if everything crashes. So you're looking at stability of the market, cash flow, government and politics in that area, job sustainability and growth. You're looking at the net migration in and out. You're looking at crime. You're looking at a lot of those different factors when you're analyzing the market. So real estate laws and taxes can be huge. Here in California, you got the highest tax rate is 13% now. So most people are not in that. They might be at 5 or something like that, which is fine. But out in Tennessee, for example, if you own property in your own name, there's no state income taxes. If you own it in an LLC, there's a franchise and excise tax of 6% of your revenue. But you can also do an LLC in Tennessee that is a Tennessee LLC, not a California LLC. And if it's 95% family owned, then you can be exempt from that franchise and excise tax too. So there's a way around it, is all I'm saying. So, one of the things on here I talk about is risk mitigation, and which starts off with the legal structures and liability structures and the taxes in those states. So a lot of the turnkey providers in those markets can explain to you, hey, does it make sense to set up an LLC in this state? Or do you have an attorney in that state or a CPA in that state that I can ask these questions to? And they have those team members, which I think that's really important because if you're dealing with, for example, in Tennessee, if I didn't tell you guys right now that don't put your property necessarily in a California LLC. Maybe you form a California LLC and go register it in Tennessee, because whenever you do business in another state, you should be registering that LLC in that state. Then all of a sudden, you're paying the 6% tax. But if you would have just said, I'm going to form the Tennessee LLC instead, and then registered in California because I live here, then there's no tax. So there's little things like that could be substantial. And also, when it comes down to liability protection, most attorneys, most of the turnkey providers aren't going to go and provide you all that information, because they're worried about the liability associated with telling you this information. And so right now, I'm going to tell you guys, I'm not an attorney. Go get your own legal advice. But what you're doing when you're looking at which type of entity to form is, a lot of attorneys will say, oh, go put every rental property into an LLC right away. That's not necessarily the best way to go. So if you own one rental property, an LLC is going to cost you $800 in California, plus you have a tax return, plus you have bookkeeping for it. You have a lot of little overhead. Maybe it's $1,500 a year or $2,000 a year to form an LLC and keep it up and running. And if you're making $200 a month in cash flow or $300 a month in cash flow on a single family home, it doesn't necessarily make sense when you could go through and get a better insurance policy for a slightly higher cost. Like our one of my largest investors is our insurance agent, and we have a $2 million general liability policy with 12 months of loss of rents coverage. If there's a fire, we get paid 12 months of our rents until that's up. We also get dog bites and domestic violence and things like that covered, because these are the things that insurance companies have had to make claims on before, and they put exclusions in the policy for those because they've had to make claims, And so they're protecting themselves, but these are the things that you want to get allocated inside your insurance policy there. And so you're gauging whether you set up an LLC to give yourself that protection, or if you go through and say, okay, you know what, I'm going to have a really good general liability policy that has a lot of these exclusions taken out, and then I'm going to get an umbrella policy for another couple $100 a year on top of that, for $5 million or $2 million of additional umbrella policy above your current insurance policy. So you could go either way. And if you also want to look at your own individual net worth, what are you trying to protect in the first place? If you don't have a lot of net worth and you're not worth a ton of money, then by putting it into an LLC, what's the reason? Is it to go after you above your general liability policy or something like that, above $2 million? If you're not worth at least $2 million, then why put it in an LLC in the first place? The only real risk there is the exclusions in the policies that you want to understand and realize these are the risks that you're taking by not having it in an LLC if you ever got sued for any one of those items. And it was hugely detrimental. I know people that own tons of paid off, free and clear properties in Redondo Beach, like 10 of them in their own name, free and clear with no loans, which you would think that's a lot of equity. That's really scary. They've been doing it that way for 20 years in their own name and have awesome insurance with umbrellas and have never had an issue. And a lot of it comes down to how do you manage properties, how do you treat your tenants, what issues come up, can you go through and have proper tenant retention programs in place. On the tenant retention side, it's really, really huge because, doing birthday cards, Christmas cards, holiday cards, going through and communicating with your tenants correctly, doing that follow-up after the repairs happen. All of those things can be great for tenant retention, but also having a proper relationship with your tenants as well. So you had a question over here on liability
As far
structure.
as the insurance, you're talking about dog bites and whatnot. I've heard a lot of insurance companies, once you start filing claims like that, they'll drop you off the policy and how.
So insurance, in my eyes, is for major issues that come up. So there's $1,000 deductible programs, $2,500, $5,000, $10,000 deductible programs out there. We usually do a $2,500 deductible program, but we don't file a claim for anything that's under $5,000. So if a dog bites somebody and they sue you personally for it, or sue the management company and sue you for it, and the management company is usually listed as an additional insured on your insurance policy, but if they sue you, it could cost you $2 million. I know somebody that got bit by a dog and won $1 million lawsuit because he got bit and had a scar on his chin right here that was barely able to see it anymore, a couple of years later. But that's $1 million, you know what I mean? And so, like that kind of a situation, you got to file the claim with the insurance company. You can't worry about that. If you have one claim in years of like one major claim like that in tons of years, then great. They're going to drop you when you have 10 claims that are $5,000 when your deductible is $2,500 and they have an issue. If you have one fire or something like that, or one major incident that occurs, which is going to be obviously extremely rare, then they're not going to drop you for one instance like that. It's reoccurring issues that they're going to be worried about. So does that make sense? So and having a good insurance company that knows what they're doing, as far as risk goes. So we have a blanket policy on a lot of our stuff while we're renovating, because we don't have to have what's called vacancy policies in place. So if it's vacant for more than a month, most insurance companies say, I want you to go through and get insurance for the next 3 months of as a vacancy policy that literally costs you like 75% of a year, 50% a year in actual coverage costs. And so on our blanket policy, because we do so many of them, we don't have to have that coverage. They just know inherently a certain percentage of our properties are going to be vacant during renovation until they're occupied in a couple months, So does that make sense? The quality of the insurance company is very, very important. So that claims history, you can get real cheap ones that, don't necessarily provide enough, coverage for you. Like there's one major thing with insurance is having full replacement cost coverage, not depreciated value coverage. Depreciated value, they say you bought it for $100,000, you owned it for 10 years. We say it's only worth $75 now, so you have a total loss. The fire burned down the whole house. We're going to give you $75. Or the fire burned down 50% of the house, and we're only going to give you 75% of that cost because that's what it's worth in our eyes. So replacement cost coverage means they will rebuild your house for you. And we even get builder code upgrades, meaning if there's a code change with the city, they will upgrade it to the new code as well, not just what your previous property was, built to, So if you have an electrical change where, like here in California, that's a huge deal because they have all this new retrofit stuff for, energy efficiencies and things like that, where you have to pass certain requirements. So if your house burns down and you want to rebuild it, the insurance company could say, oh, no, we're not going to pay for all those brand new windows that are energy efficient, or the furnace and an AC unit now that really needs to be this high of a quality of energy efficiency versus the other ones, So that can be a big deal here, specifically. A lot of the other markets don't necessarily have as much stringent requirements as California does. California is probably one of the worst. So, but see, these are the types of things that a turnkey provider in your area should be able to tell you, and if they can't, they should be able to refer you to somebody that can. So sometimes they don't want to get into that business. They don't want to be able to be. I act a lot like a financial advisor for my clients because I understand these sides of things. And so I don't mind explaining, the philosophies behind it. But a lot of the providers are going, I don't want to waste my time with you. You're not a client of mine. You're a buyer. That's how they think of you sometimes. So you want to be careful on that aspect. Let's see. I mentioned about the resources. They also have financing resources. So a lot of the turnkey providers, they have their typical banking resources, to get you loans if you're putting 20% down or 25% down and getting a bank loan. That's normal. What they can have that they don't always have is in-house financing or private financing. Some of the ones, like when you were talking about the buying it up front before the renovation occurs, sometimes they'll provide you financing on that. And that could be at 9%, 10% plus, as far as, say you didn't have all the cash and you wanted to buy something for $150,000, but you only had $50,000. They may be able to provide you the loan for that $100,000 so that you can get the rehab done in your name and all that's taken care of, and then you go through and refinance afterwards and pay off that private lender that lent you the money for your renovation, because the traditional financing companies aren't going to provide you the loan until it's renovated and typically tenanted. So sometimes they'll do it before tenanting, but you need to have really strong financials because your debt to income ratio is what comes into play there. They normally take 75% of your rents and take that net number as how much they add to your income when you're buying a new property. If it's rented. If it's not rented, they don't count anything. And so you need to make sure you're making enough. Your debt to income ratio needs to be usually less than around 40% of the total in order to qualify for financing. It's a little easier to qualify in some of the Midwest markets where the properties are 100 to 200 versus you try to do a rental property here in California where your debt payment is $3,000 a month or $2,000 a month. It's going to be harder for you to qualify if you're not making a really good chunk of income on a monthly basis from your job, or your other income in different ways. Does that make sense? Okay. Let's see. Any other questions on the differences and things like that with with turnkey providers, or what to look out for, what to be careful of? I know I just hit you with a ton of information, so you're probably all in food coma now as well. So let's see, where are we at here? Okay. Well, so some of the other things to look out for, as far as we talked about where to buy, the pros and cons of certain areas. We talked about the market analysis of those areas, the financing. Make sure you do your cash flow analysis correctly. A lot of the turnkey providers do not include a repairs allowance or a vacancy allowance in the financial numbers. You put that in every time, including property management, insurance, property taxes. Those are the main things that you want to put in there on the analysis side, and make sure you back up and increase your reserves for all those major issues that might be coming down the line that aren't finished right away. And so that's probably the biggest challenge, I think, with most turnkey providers is they say it's turnkey, but it's not because it's not renovated fully like it should be. So that was probably the biggest challenge with this with turnkey providers. Let's see. We talked about the inspections and the preventative maintenance up front, vetting the property managers and the other team members. Do background checks on the managers. Talk to those other investors. Find out, and go through the major list. So I'm going to provide this to you guys, which I outlined, the issues with tenant selections, the issues with delinquencies, the issues with maintenance, tenant retention, and the accounting and other communication. So that way you guys kind of have a list you can go through when you're talking to different property managers and asking them each one of these questions. So if you guys email me afterwards, like I mentioned, my printer was acting up, so I will email you guys this if you guys email me. I'll also email you guys kind of the main benefits when you're working with a turnkey provider that I wrote a blog on, that you guys can take that and say, use that when you're talking to different providers or different property managers to say, okay, I'm going to use this blog to format my questions, So usually the top 5 things, are viewed quickly online. So you're always doing top 5, top 7, top 9, issues when you're blogging. So if you guys didn't know that, I learned that a couple years ago, and it was amazing to me. It makes it a lot easier to write blogs. So
Is that just the same one that you guys, like the OCG education?
I don't know if it's on there or not. I don't know if it got put out or not.
Like,
So.
we'll use the email, the one that, the one that sends like the reminders for this kind of.
Oh yeah. Go ahead and email that. Yeah, that absolutely. Yeah. So we talked about the legal and tax structures and wanting to get a CPA and attorney in each market that you're doing business in, and the attorneys are. You want to have a CPA there, but then the attorneys, you need different attorneys. You know, you need a closing attorney. That usually out in the Midwest markets, there are closing attorneys. You want to be able to have an eviction attorney. You want to have a contract attorney, maybe a attorney that specializes in lending, which is another thing with different markets. If you're doing any kind of financing or borrowing money, you want to understand the lending laws in that state as well. You know, is it a judicial foreclosure state or a non-judicial foreclosure state? Which means a judicial foreclosure state means that if you're going to foreclose and you lent somebody money in that state, then you typically have to sue them to enact the foreclosure proceedings versus going through normal traditional channels, which might be a lot shorter of a period of time, not having to sue them to actually foreclose on the property. So we talked about making sure that you have the proper exit strategies. If you buy right now at top dollar in the market, don't expect to sell it and get all your money back. You're going to sell it, you're going to pay 6% in commissions and 2% in closing costs, or 2 to 1% in closing costs, and you're going to lose 8% if you went and sold right away. So you want to look at that if you're going to go and hold it long term and understand, okay, am I okay with that, or I plan on holding it long term, or do I feel like I need to go and get built-in equity? What we do for those investors that don't want to take that risk is we do a joint venture at our cost, where investors go buy it from us with 20% down and get a bank loan at our cost. We do a 75-25 split on cash flow in their favor, and then we do a 50-50 split on the equity and the principal reduction in the loan whenever we sell it. And we own a brokerage on the ground in Tennessee, so we can go and sell those properties and things like that if there's ever an issue. But we don't make any money up front. We make a piece of the cash flow along with our investors, and our investors have us on their team, and then they have a built-in equity piece, so if they do want out, they have a built-in exit strategy. Some people are not comfortable with the JV structure, and I honestly don't want a JV with everybody because I've dealt with some crazy-ass investors in the past. And I'm like, yeah, you're a little bit too neurotic for me to deal with consistently. I don't want to deal with you for 20 years, so I'm going to pass on the JV with that. But, you know, it's a matter of getting to knowing somebody and understanding who they are and what they're comfortable with and what their personality is. Because when you're dealing with people's money, everybody's different. You know, my brother, which is now, he's been working with me for 10 years, but beforehand, he was working at Union Bank. There was a teller there. He's like, people with their money are crazy. You know, that it's a heightened emotional level when there's money involved. So you realize that, you know, there's issues there. So that you want to be very careful who you do business with. We talked a little bit about the tenant landlord laws, but making sure you understand the tenant landlord laws in that market. California is horrible for tenant landlord laws compared to some of these Midwest markets that are very in favor of the landlord. I can literally get an eviction done in 2 weeks, where I got the eviction filed through the court and everything in 2 weeks, and then within 10 days they're out of that property afterwards because they have 10 days after we get the eviction for them to vacate. So in California, if you do it wrong, it could take you a lot longer. I mean, it could take you 6 months to a year, and if you deal with a professional tenant that knows the tenant landlord laws, you do anything wrong and you are screwed. So you need to go directly to an eviction attorney if you're dealing with evictions in California to make sure you do everything by the book and know exactly, okay, I got to send this notice, then I got to wait this many days, then I got to send this notice, then I can file eviction. You know, do the process that eviction attorney tells you. Okay. We talked about the renovation quality and the tenant selection quality as well. So I think that's pretty much it for today, guys. I really appreciate you guys coming. If you guys have any more questions, I'll be available for about 15 minutes after this. But otherwise, you know, feel free to network, and I'll send you this as well as the blog if you guys email me. So that way you guys have that kind of list to ask questions for these outside providers and outside turnkey providers or property management companies as you go forward. So cool. Thank you guys. Yeah.